Okay, I think we can begin. Hi Joe. Finally, you're here.
Hey, how you doing?
Hello. We can start now. Good morning, good afternoon, good evening from wherever you're joining us. My name is June Kangula. I am in charge of the pre-summit events at ACES. And I am so glad to have you for the fifth session, which is the final session, which will lead to us meeting in Cape Town. I hope I will be seeing most of you there in sunny Cape Town. And this is an opportunity for you to grab your ticket last minute as I just quickly introduce Shagun, who will come and then who will usher us into the session. But so far, this is the fifth session. We have spoken about the real talk of investor and founder. We have talked about investing in non-traditional tech like sports and creative. We have looked into LPs and GPs. And now we are concluding with the exits, which is a pivotal moment for any investor. We want to talk about exit, how the experience of these investors and exiting, what they did differently, how it came for them. Are there any other deals that they have lost? And those ones that they have exited, what is the difference between all those, the deals that they gained and the ones that they lost? So, yeah, before we start, I hope you have had a quick moment to grab a ticket and I can see you in Cape Town, and I may promise to get you some wine in Cape Town. We don't know. So yeah, it would be a great time to see me. I hope Joe is coming. I see him nodding to the wine. So I will take this opportunity to welcome Shigun, who will welcome the panel. He will introduce himself and he will introduce today's topic and why it's important. Shigun, the floor is yours.
Thank you so much, June. Please confirm that you can hear me well.
Yes, yes, we can hear you.
Fantastic. Good day, good afternoon again, everyone, and welcome to today's masterclass, The Anatomy of a Deal, Lessons from a Recent Exit. My name is Shagun Cole, and I'm the CEO of Masai, Africa's premier M&A marketplace that helps founders sell equity for liquidity. At Masai, we are on the front lines of exits every day, so we know firsthand how rare and valuable it is to hear the real story behind a successful exit from people who lived it, just like June referenced. Today's session is special because we're going behind the scenes of an actual exit. We'll unpack the full journey from the moment the opportunity was first spotted through the growth challenges to the final exit. And we're privileged to have both an angel investor and venture capitalist who back this company here to walk us through it. This is in theory, guys. This is real money, real risk, real relationships, and real lessons that can help all of us structure smarter and more resilient deals in Africa's early stage ecosystem. Over the next 60 minutes, we'll explore how this deal was sourced and structured, what went right and what didn't, how they navigated founder relationships and key challenges, and ultimately what made this exit work. We'll also leave time for your questions at the end, hopefully. So please drop them in the chat as we go. Now, let me introduce our distinguished panelists. First, we have Finyi Ogunlesi, Managing Partner at Regal Stone Capital. And joining us as well is my Egbon, my big brother, Joe Kinvey, the chairman of Hook. Finyi, Joe, welcome. Before we dive in, I would hand it over to each of you to introduce yourselves properly and share a bit about your investment journey. So let's start with you, Finyi.
Okay. Hi, everyone. Can you hear me?
Perfecto.
Okay, awesome. So I have a decade plus experience just in investment management. And I was lucky enough to come to the private capital side. And my last role was principal slash chief of staff, where I was in charge of fund operations, investor relations, and just providing strategic support to the managing partner of an Africa early stage fund. That was fortunate enough to get an exit from one of the fintech unicorns. And today, I lead Regal Stone. Regal Stone is a fund for culture and creative businesses in Africa. And so again, still the same investment rigor and fundamental focus that I expect to deliver. So happy to be here.
Yeah, thank you, Finn. It's a pleasure to meet. Surprising that it's the first time we're actually meeting on a meeting all together. But Shegun and I have spent quite a lot of time together. My name is Joaquin V, and I'm now the chairman of Hoke. I'm also one of the co-founders, and Hoke is an investment syndicate that invests in founders across Africa and the diaspora. We've been on this journey for slightly over 5 years. We've invested in just over 100 companies, a lot of failures, some successes. And personally, I've also done about 35 angel investments. And the reason why I'm an angel investor is because when we started the syndicate, we had to make our own investments. That's all, that's the only way that other people can follow us. And yeah, I'm here to share the good, the bad, and the ugly with all of you.
Awesome, awesome. Thank you both. Now, before we get into the deal itself, I want to set the stage for why this conversation is so important and why it matters right now. We're seeing some really interesting data come out of Africa's M&A ecosystem. At Masai, we track every acquisition on the continent, and the numbers tell a compelling story, right? Since January 2020, we've recorded 208 acquisitions across Africa's tech. And that's not a lot, right? When you compare it to other emerging markets. But here's what is interesting. The trend is accelerating. We're seeing more deals quarter over quarter, and fintech alone accounts for nearly 40% of all exits. Joe, you have seen hundreds of deals across Africa's venture ecosystem through Hook. Against this backdrop, where exits are still relevantly rare but growing, why does this particular conversation and dissecting an actually exit matter right now?
I think for any investor wants their money back. If somebody gives you capital, the idea is they want money back. Forget the whole impact case. It's all about money back. Shegun, I think as part of our session yesterday, I asked if I could share just like a data
Yeah, and we're going to
on
jump right into it.
yeah. So over the past 5 years, while we've invested in quite a lot of companies, we've also compiled data on exits because we know that that really matters. And what I want to do is I want to share this very short table that we put together last year to show what exits looked like at Hook. And I'll try to keep it very, very short. If anybody wants access to this, happy to share it. It's in our annual report that we release every year. Can all of you see my screen?
Yeah, we can see a screen.
You can see my screen. I'm going to try to zoom in a bit. So what we did was so by the end of 2024, we paid out about $300,000 to investors, and not all exits are the same. So we compiled 8 companies, and what you see is, just the preset of the data is if you invest an average of $1,000, then you'll like we didn't use the actual data, so it's just more like a sample amount. And what we've seen over 8 companies is the last 3 companies at the bottom, the last one returned the money that we invested in. So if you're an investor, you put in $1,000, you get $1,000 back. You didn't make any money, you didn't lose any money. And if you put that money in the bank, you're probably gonna make 3 or 4% on it, depending on where you are in the world. Company 7 did really well. It returned five times the money. So if you put in 1,000, you get 5,000 back, which was great. Company 6 as well. But what's quite interesting is when you look at company 1 to 5, you'll see that they barely returned any money. So 0.2x, i.e., when you put in $1,000, you get 200 back, which really sucks. And what we've seen over the years is people often try to handpick deals, especially when it comes to angel investments. And everybody would want to invest in company 6, but like I couldn't even pick company 6, having invested in so many companies. And what we're saying is in the angel investment asset class, you're going to come across different type of returns, and you ideally don't want to handpick. You can't handpick the companies that will be successful. And it's all about hopefully spreading across enough companies to get a decent return. Overall, if you happen to invest in all these 8 companies, you're still up, which is about 30% per annum over 3 years. Definitely better anywhere across the world, even in Nigeria. So again, we've had people who've done quite a lot of investments, and having spreading your investments across multiple companies is something that would work in the angel investment asset class. But if you try to pick and choose, or you only want to do one and that's it, you could get very lucky where you invest in company 6, 7, or 8, or you can get very, very unlucky where you invest in company 1 to 5. I hope this helps, and I will stop sharing. Now I don't know how to
Thank you,
share.
Joe. That was incredibly valuable. I know everyone here is already thinking about how these insights apply to your own portfolio. But thinking from your perspective as an early stage investor at Regalstone, what makes this moment the right time to share these lessons? I mean, especially when we know that most African startups are still in that build phase and not that exit phase.
Um, So I'll say that again, if you see any exits, right, in the African ecosystem, it's really just a validation of a lot of patience and a lot of, I guess, discipline that has happened in there. It's a lot of work. Um, so again, for this particular deal that I'm fortunate to be on this panel for, wasn't part of the deal sourcing. Just disclaimer, but again, joined the team afterwards. And what you will find is that, again, the best founders really, they show as operators first. And then the storytelling comes afterwards. We sort of all know this, right? Um, and for a fund manager, right, wearing that lens, again, is key to always have clarity. So again, you have 20, you have 30 portfolio companies. You sort of have an idea of who the poster child, the good children are in the bucket, right? And so you want to quickly have clarity on those. You want to quickly have founder alignment, and that's key. I think that's the messy middle that we all as investors find ourselves in, right? You've done the investment, you've moved on, but that middle part is key. It's key to this story. It's key to how we sort of move from just announcing fundraising to exits. And so that alignment day to day, sometimes again, if you're an early stage investor, it is a situation of you've given 100K or you've given 150K, and then there's this massive company and your check size is really now really, really small. How do you manage it, right? It's the communication sort of rhythm that you've developed with the founder that will ensure that you're still able to create value and you are able to exit. Because again, exits can happen to you or you can make it happen. And so if you have to make it happen on your own, then you as a fund manager, you need to then be intentional about certain things. So there's a strategy around it. And so again, it's good that this conversation is happening so that investors, operators, founders have a good sense as to how to sort of intentionally play it out.
Interesting, interesting. So now what I want to do is take us back to the beginning of this journey and walk through it step by step so we can extract every lesson possible. And Joe, I think this is where your perspective becomes critical because you were there at the very start. So let's rewind the clock and break down this deal from the first contact to final exit. So let's start at the very beginning. Joe, how did this deal first come across your desk? What was the initial introduction or connection?
As a syndicate, there are a lot of interesting dynamics depending on what stage your syndicate is at. If you're a new syndicate, nobody cares about you. Nobody wants to talk to you because they're like, we don't even know who you are. We don't know if you've done an investment before. As a result, what we saw ourselves doing around 2020 and 2021 is we're chasing deals. This actually happens in the VC space where a lot of like the VCs are chasing the best deals, and then all the founders are chasing all the VCs. It happens all the time, and it's not new to us. I remember one investment that we did in 2020, we essentially ended up paying 2x on the premium because this deal was oversubscribed, but we knew it was our second ever deal at Hook. We knew that this is a potentially good deal, and we'd rather pay a premium to get in than to miss out. And a lot of syndicates, nobody would join your syndicate if you don't have a track record. And we care more about getting a track record to say, hey, we've actually done investments, instead of hoping that we'll find companies. Companies will always reach out to you, but as a syndicate, oftentimes you're always chasing the good deals. This company that we invested in, I think, 2x the premium. About a year and a half later, they end up raising the Series A. They're doing really well now. So that chase was very much worth it. So, like, we've had to chase deals, especially when you know that the founder is great. Now, every now and again, you make a mistake, which is very normal. And the fact that 8 out of 10 companies actually die, you'll most likely get it wrong. But in the early days, we chase deals. Now we don't chase deals anymore. Oftentimes, so let's see. Last week, there's this Techable article that came out about a company. I had about 5 people reach out to me. They're like, "Hey Joe, what's happening?" So 5 people in our syndicates. Like, have you spoken to this company? Nope, I haven't. Can you speak to this company? I'm like, yeah. So we had a call with the founder yesterday, and we posted. So our process is we find a deal, we speak to the founder, and then we post it to the syndicate. I think we had, last time I checked, about 20 people who were interested. That's a good signal. So now founders are willing to take our calls because we've done this for quite a while. We've done like quite a lot of deals. But back then it was much harder. I have a feeling that we will not pay a premium for this deal because we have a reputation in the market. But yeah, we've had to chase deals a lot of the time. But like we also get a lot of applications. As far as I remember, we've maybe invested in 2 companies that we received applications for, and we're getting like about 1,000 a year. So it's a very weird dynamic. I hope that answered the question.
Yeah, and which leads to my next question, right? Because Joe, just as you admitted, right, at the early stage, what made this founder or this startup stand out? I can imagine founders in this masterclass asking themselves, okay, if you want to send in applications, if you want to reach out, what made that founder stand out? And I'm talking about the founder, the masterclass that we're talking about, right? What made the founder stand out or the startup stand out? Because, like you said, you've looked at dozens of deals at a time. And we know from the data that, for example, fintech dominates exits in Africa. So if this was a fintech deal, how did you know that it wouldn't just be another payment app fighting for market share?
Yeah, I think at least back in 2020, there were very few of these companies in the market. And so I lived in Ireland back then, and we could tell you examples of this company that were successful in Europe or America. We looked at the market and nothing like that existed. It was very obvious that the market existed, the founders knew what they were doing, and they built a good product. So that really helped. Like the founders really, really understood what they're building. They knew exactly the clear path to getting their first customers, clear path to, gaining 1 million customers, licenses, going to B2B. So the path was very clear. And also the pitch deck was easy to digest. Oftentimes, if I have to come back and ask you 20 questions about a pitch deck, you're not doing it right. But if I can read your pitch deck, I'm like, yes, I understand what this person is doing. That really helps. The last thing I often look out for when I'm, looking at decks is, or speaking to founders is like, am I learning something from this person? Do they have a certain level or depth of expertise that will make them the best when they decide to attack this market? So and this founder or founders, it's one male and one female. They had it all, and I think 5 years later, we're still correct and we're still in that deal, and the company is actually thriving, which is great.
Amazing. Thing when Stone came into this deal, presumably after Joe, what did you see that made you confident enough to write a check, right? And more importantly, at what stage did exit potential start factoring into your investment thesis?
Okay, I'll say that for Stone, the way we sort of look at deals today always center around, again, first thing first, again, just picking back off Joe, is clarity. So it's good to really see how clear the founder sees the customer's problem, right? How clear it is, and any biases around it. So again, that means you've been in the space enough to sort of recognize some pattern, right, in the space that you're trying to solve for, and then you know the biases, you're clear around it. It's also good to be able to see, of course, the fundamentals, right? The economics of the deal. Is the market sizing really the market sizing? And what kind of value creation pathways do you see you adding, right, to the company? I'll say that again, for this particular exit, which was my former role, right? It was really around, again, a lot of helping with that messy middle, like I had mentioned earlier, a lot of helping with that governance, a lot of helping with value creation, a lot of discipline, um, especially from the founder, a lot of, again, reporting as you're supposed to, and a lot of managing that relationship with the founder. So I'll say the alignment is key. Of course, you're not a micromanager, but you want to be able to just be there around, because you know this is your poster child, right? Just be around at their birthday parties and just be around, just be around them and know what's happening to add value. Uh, I'll say it, so yes, clarity, the founder alignment is key. Of course, there's the economics of it, the fundamentals of any deal. But discipline is also key. It's good to be able to see a disciplined founder that is really can deliver, basically execution. Very disciplined founder that can deliver, and so it's not easily. And again, as you work as an investor, your work as an investor sometimes is to within the noise to bring that clarity back to again where your partners, and this is how we think that you should go. So yes, I think that's how I'll answer that question.
Yeah, so and just quickly, right? Speaking of alignment and birthday parties, right? Were there any red flags that you both chose to overlook or walk through, right? Things that in hindsight maybe were important to address early, but you thought you could manage.
So again, okay.
No,
Did you
go
want
on.
okay.
No, yeah.
Again, I would say for early stage companies, there are always a lot of red flags, right? Because if you're going in really early at the first check or you're the second check after an angel, a lot of red flags. You're just going on. I think this can happen. You trust the team. I'll say in terms of red flag, if you are working with a company that is in a really fast-paced sector and heavily regulated sector, anything can happen. Really, the rug can be pulled under their feet anytime, especially if it's in Nigeria or any part of Africa, really. So that's really the regulatory risk is high up there for any heavily regulated company. So I'll say that's something that every investor is always looking at, or every founder should be aware of. And what gives you comfort is knowing that the founder is disciplined enough, is on top of things, agile enough, has that 360-degree operational excellence, right, to see things and move fast.
Yeah, I wanted to add that, to be honest, after you write a check into a company, like whatever happens after can get very blurry. And you stay on top of the company or stay on top of updates through investor updates. For me, after we write a check and I don't hear from you 6 months, 9 months, it's about time we just write it off. Now, 90% of the time, we've been right, where you don't hear anything from the founder, and then they follow up with usually two things. They want to raise money or they're shutting down. And the red flag typically happens after the investment. One thing that we've done diligently is essentially just to coach founders into sending regular updates, even when things are not working. Because if you have a lot of investors on your cap table, you'd be surprised how much they could help you. Like again, myself, I'm also a founder, and I this year I've been very diligent in sending investor updates. And every single time when I'm stuck, I always throw it in there. And guess what? My investors always come back to help me. But like many times, the red flag is when the founders are not sending updates. And I see them, like, so I see them in person. Hey guys, boss, I haven't heard from you in a while. What's
You
happening?
see them at mixers.
I see them, like, I see them. I saw one the other day, and he's like, I was like, boss, I haven't seen an investor update in a while. He's like, that's my only scene. I said, that's the worst scene. We need to see investor updates. It helps so much. And also, like for me as a founder, it helps me reflect on what the past month, 3 months have been like. You'd be surprised how much can happen in the founder's life cycle. So when founders are not sending updates, it's a red flag. What we've done at Hoke is every 6 months or so, we take a pause and we look at companies that we haven't heard from in a while. And I mean, 100 companies, quite a lot. And we just reach out like, hey, we haven't heard from you in a while. How's things? How's business? We go to their social media page. Like, are they active? Are they posting? Or like, do they still have the job title CEO, COO on their LinkedIn? Because some founders just they quit quietly. One example that I had is this company, everything was finished. I couldn't hear anything. And even the website was not active. And that's when I had to go to the investors and tell them, sorry, this one has gone. But the good thing is everybody that we work with, I hope, they're fully aware of the risk and the industry that we're in, which really helps. But yeah, like investor updates really, really help.
Mm. Yeah, Finn, every deal hits turbulence, right? What were some of the major turning points or challenges along the way? I'm talking about moments where things could have gone sideways. Maybe a key hire didn't work out. Maybe competition intensified. Maybe unit economics weren't materializing as expected.
Oh, I'll say every deal is unique. And so again, if you are, what I've seen is again, because if you are doing early stage, right, even if it's on the creative side, you've gone through the projections, you're really going on optimism, right? You believe that there's a market in here. So some of the challenges that can come is maybe integrity, right? You saying that something is, and then we go check or verify and is not. Um, you saying that you've signed an agreement and is not, you've not signed, or you've just your end of the agreement is signed, the other party hasn't signed, and then it's still hanging in there. So a lot of operational stuff that could again lead to the monetization of the business, right? Seeing it scale. As some is key. It's crucial to again deciding whether you want to go forward or not. And so I'll say for me, it will so far it has been integrity. Um, it's been again because market sizing you can figure out every other thing, but just verifying that these people are who they say they are, they're not lying, or maybe there's a regular. They've said they've gotten this license, and typically maybe in that country they're not yet giving that license to everybody, or maybe they're still far. Again, there will be licenses. They say they are moving, but it's not moving. It can be a year. So yes, I'll say integrity, just being transparent enough. As a founder, saying what it is and saying again, these are the risks, this is what the situation is. And if you have mitigants, right, the investor will decide if that mitigants suffice or not.
All right. Let's fast forward to the exit. Joe, you touched on this in your presentation, but I want you to dig deeper. How did the opportunity to exit actually come about, right? Was it opportunistic? Was it planned? Did the acquirer approach you, or did you go out seeking offers? What was this? What was this? Was like basically was this a strategic buyer or a financial buyer? Talk to me.
Do you want the good exit or the bad exit? Because
Everything.
all
Lay,
right,
lay it out.
let me get you the bad exit. It's actually quite short. You get an email from the founder to say, "Oh, we're shutting down." Yeah, that's it. And also, your money has been finished a long time ago. You're hoping that they figure it out, they get some momentum, and they will hopefully return your capital because ultimately that's what investors care about. So that's the bad exit. We've had plenty of those, and every time a bad exit happen, Joe will have to sit down and write an email to the underlying investors, and it sucks every single time. I still haven't gotten used to it. The two good exits. The first one is a fintech that we invested in at a pre-seed stage. They were doing really well. Then they went to raise a seed, and they went to raise a Series A. And as the Series A was wrapping up, I reached out to the founder, like, "Hey, if there's an exit opportunity, we'll definitely consider it." Well, first of all, what that means is you should have a relationship with the founder. Sometimes investors deploy capital and then they say, "Oh, I'll see you when I see you." In our world, it does not work like that. You have to build that relationship with the founder. And what we said was, "Hey, we see that this cap table is wrapping up. Keep me updated. I'll see him. I'll text him." And so the round was oversubscribed. And when other investors wanted to get in, we were top of the list of people that could be bought out. And that really helped tremendously. But it's not big. Again, we weren't the only investors on the cap table that could have been bought out. But because of that relationship, staying in touch, checking in, introducing them to other investors, that really, really helped. So it was very strategic for us because it was sometime last year and we needed to start showing more positive exit to our investors. And I would like to say that we engineered the exit and we went to the investors, we paid everybody back, and everybody was happy. A lot of investors, they were like, I took this exit purely because I haven't had an exit. I'm like, yeah, well, I'm glad to pay you X amount of money. And I paid that money out with so much joy because I also made money. Because
Clearly.
we only make money when they're positive exits. So a lot of the work that we do, like Hoke is a membership community, you pay $100 a year, but that's just to sustain it. For us to make any significant amount of money, it has to come through carried interests. And I wasn't doing it for the carried interest, but when my investors get paid, I get paid, the team gets paid, and it's a joyous occasion for everyone. The second exit that we had was a secondary sale, and we sold a small piece of our holding because this company was doing really well. And also, some investors decided to sell because they're like, hey, I want to take some money off the table. We actually saw a lot of investors who essentially divested the amount that they invested. What that means is whatever happens after, if it goes to the moon, great. But if this thing doesn't work out, at least they took their money back. And again, like every single time I do a distribution, it's a joy for me to be able to prove to people that we can actually return capital. So three types of exit: one that we see more often, one that we engineered, and the third one was a secondary sale.
Amazing. And Finny, so I want to get your perspective, right? How did you know that this was the right time to exit? A conversation we rarely have across the African continent. How did you know this was the right time to exit? Because here's what's interesting, right? Our data shows that South Africa dominates Africa's M&A activity, but deals are happening across the continent, right? From Morocco to Kenya to Cote d'Ivoire. Did geography play a role to how attractive this exit was?
Um, I'll let me backtrack. So I'll say exits are they're really a natural progression of showing that a company is growing, right? Yeah, it's scaling, right? Um, and then if you are a fund manager, different dynamics might lead you to want to exit, even whether it's right or not. So again, like I said earlier, it can happen to you. Again, somebody just comes saying, we're buying out, we want to buy this company, and then everybody gets their check back. Or you can make it happen. And most times, if you're a fund manager with a typical fund structure, 10 years, whatever it is, as the fund life, sometimes you have to make it happen. Or most times you have to make it happen. And so again, that means secondaries. That means you going, taking your portfolio company as a sales mandate and shopping it around, sometimes looking for the investor that will buy, right? And that could be maybe you want to meet some LP expectations. It could be on the back of maybe you want to raise the next fund. And you need to show workings, as they say. You need to show that you've done the work. It could just be okay. Maybe this is the peak that we see this company. So again, just on the back of the projections we've made. Any other thing we might just be shooting ourselves in the foot. Again, you have to be real with yourself as much as you love the founder. So again, different things around that kind of. So I would say for this particular company, I think there were two exits in there. One was just by chance, and then the second one was really on. Yes, the market size for Nigeria is big, right? So yes, the geography had a good part to play, but the company was also really doing well. And although it was a partial exit, right, it also meant that it did well for the fund that I was at then.
mm,
And so
mm.
it goes back to a lot of it is still is you again, sometimes you going to shop,
Yeah.
right? I want to shop, I want to sell this stake in this company. Um, you look for the bigger guys, the later stage funds or whatnot, and say, this is why I'm selling it. Again, the dynamics of the sale there is a different conversation entirely once you are shopping. It's a different, because that
Yeah, dynamics. Yeah,
right?
dynamics, right? So quick one. So since we're talking about dynamics, let's talk about the negotiation itself, right? What were the key factors that influenced how the deal was structured and priced, right? And were there any sticking points that almost derailed the deal, right? Because I can imagine in a market where there are only 208 recorded acquisitions in 5 years, there isn't a ton of comparable data to benchmark against, right? So tell us what factors influenced how that deal was structured and priced?
I'll say for a fund manager, typically the ultimate is always like you go to IPO. You go to IPO, you make the maximum amount of return you can get. But sometimes if you have LP expectations, again, because I would say price is really what you've sold it, right? Valuation is an entirely different ball game. So if you've said that this company is valued at 200 and then it's now time to sell it to a later stage, 200 million, I mean, it's time to sell it to a later stage company. And of course, day two, they've done their projections and they're looking for that headroom, the best pricing that will ensure that day two, they meet certain return metrics. Um, you might be selling at 100 million. And so again, if you're selling at 100 million, you think, okay, when did I get in? Did I get in at 1 million or 2 million valuation? And so it still makes sense. I'm selling at 100, right? I didn't, yes,
Right.
how many IPOs do we see? Let me just be
Mm.
going, just give it, right? So yeah,
All
those
right.
kind of
All
things
right.
that feed into,
All
um,
right.
again, is in the context of your fund. You're
Mm,
constantly weighing different things, but it's really
mm,
unique to your fund, how you see the
mm,
fund economics.
mm. So last question on the exit, right? And Joe, I'm going to start with you. What surprised you most about the process? What did you not expect?
Oftentimes it takes longer than you think it's going to take. Every single one of them. From like, think one of the exits, when the company we exited at Series A, we went in at pre-seed. This thing took over 6 months, right? So you first tell your underlying investors that, oh, there's some exit coming. And then every other day, somebody's texting you like, hey, my guy, what's up? Where's the money? Right? And because you need to wait till the deal closes, and then the money's wired, and then the money's wired to you, and then you pay your investors. So the process actually takes longer than you think. And I think I saw like one company, I think it's Money Point, they closed another version of their Series C the other day. I can guarantee you this process started at least last year. So for any investor, you have to be patient. But also the other thing is, so that's the process takes too long. I want to add that before I became an investor, I was a CFO at a company where I managed an exit. I was selling a company and I managed the entire process. This thing can fall off anytime. This thing can, like, last minute, this
Hmm.
whole exit can fail. Shagun, you probably know this. There are more failed
Definitely.
exits than
Definitely.
actual exits.
Yeah.
So, like, whenever a founder tells me, we've been bought out, I say, when that money is not in my bank, I don't believe you. Because I've seen so many potential acquisitions or sales and M&A that just never went through. And even when we were selling that company, like, it was this close. It was this close from falling through. It didn't fall through. We did well. Everything worked fine. But more acquisitions fall through more than you think.
All right. Very, very true. I can definitely relate, Joe. So now, guys, I think we've walked through the entire journey. right? From first meeting to final exit. So now I want to extract the lessons, right? These are the insights that everyone here can take back to their own portfolios and even for their startups, right? So I think my first question would be, if you could go back to the beginning of this deal, what would you do differently? Fee, you first.
I think um I'll speak from the Regal Stone perspective, right? Again, back to what I said at the start, constantly looking for clarity with and then founder alignment. So once you figure out early on, you're really convinced that conviction is key as an investor. You're really convinced that this company is the poster child or is one of them, right? Top 20%. You want to align quickly. You don't want to leave it to, you want to be intentional about how you manage that relationship. So helping them get their board chairman, setting up their advice. You want to be intentional. Like you, as much as possible, a partner with those companies that you think that so that's something that I hold on to daily, right? Being disciplined, having in your fund or in your process that disciplined approach to managing those really good names in your bucket. I think that's one thing that I'll hold there. And then again, the last thing will be really that discipline, seeing that the discipline of the deal itself. Again, the price at the end, at the exit, is different from the valuation, right? So it's always advised you want to get in as low as you can. All right. So you want to get as I don't want to, I guess, cheap as you can, so that you get the
Yeah.
maximum return. So constantly thinking about those fundamentals in while you're deciding or making those deals. Um, is how I look at it today.
Great. Joe, same question. What would you do differently?
I just wanted to tag on what Finn just said. I think beyond the valuation that you're getting at, the amount that you put in at that valuation also really matters. And what I've seen as somebody who runs a syndicate is it's much harder to convince angel investors to come in at that pre-seed level because like within 24 months you get an idea and people, at least at Hoke, people have invested in a lot of pre-seed and many of them have failed, that people are more apprehensive. What I've had to do as a syndicate manager and also find a balance between encouraging people but also not giving investment advice is like, hey, I'm putting money in it too. So if you come and tag alongside me, and I think that's how I managed to do so many investments because there's some deals that I see and I think like our community should invest in, but you're overselling. And like this deal that we exited, I wish we added 1 0 to the number that we invested because Shigun, I wouldn't be here right now. I'd probably be on the beach somewhere,
I know, right?
sipping some cocktails.
I won't be moderating.
Yes. So I think it's really, really important that like when you're getting in, you want to go in, just be fully convinced. And this deal I sold it, but it was a hard sell. People didn't put money in. And then at the end, everybody's like, I wish I put money in. It's like, yes, I know you wish. So I wish, we added more capital or even just followed up at the seed. And that's one thing that we've done with subsequent deals. The companies that are doing really well, double down because it just ultimately increases your holding in that company. And I think as Finn said, it's not about the valuation. It's all about the exit price. And that's what really, really matters. And the higher you're holding in that company, the higher what you would make at the end. So
Yeah.
again, like because so many startups, tech startups, early stage companies fail when you find a good one, just double down. And that's the name of the game. And when you see a lot of funds, what they do is they keep reserves. And oftentimes it can be up to 50% of the fund. And what they do is they play that wait and see game. And when the company is doing real well, then they add more capital. And I think more angels should really think about this as, the ones that are doing well, double down and increase your stake as much as you can.
Super, super, super. So still on talking about advice, What would you say to early stage investors in this audience who are looking to achieve successful exits in Africa, right? Because here's the reality. We're still at 208 exits in 5 years. That's roughly 40 exits per year across the entire continent. So for investors deploying capital today, what's the one thing they should prioritize if they actually want to see returns? Fee?
I'll say again, there's so many things to say for different, it just depends on the context. Um, so like I already said, sort of again, I'll just reinforce is the alignment early on, and just again, it's good to see that founder discipline, your especially in the reporting, because that's the only way you sometimes are carried along, and then you can decide if you want to double down on your value creation with them. So yeah, I'll say that you want to be intentional about that messy middle. You've done the deal, you are in the middle. You are trying to figure out, it can be as long as 5 years, 6 years, trying to figure out, especially if it's a fund structure, the typical 10 year. You want to be intentional about that middle where you're helping with governance, helping with the next market expansion. You want to be intentional around managing that relationship. So have a process in-house is what I'll say.
Joe?
Yeah, I think so you have two types of angel investors, right? You have the passive ones and you have the active ones. If you're a passive investor, just join a syndicate. And also, angel investment is the act of making the investment. Like for many people, the hardest part is to get started with that journey. Just get it out of the way. The sooner the better. And the chances are you're most likely going to lose that money. But I think that's the costs of becoming an angel investor. So I'm actually, my mission next year is to encourage more people to just do the act of angel investment. I don't have, like, there's a lot of courses that I think ABAN has a partnership with the African Angel Academy. Do take the course, but also do the investment. That makes you an angel. The second part is if you're a passive investor, you just want to put the money and then watch it, join a syndicate. Now, I'm not trying to sell Hoke to you, but Hoke is probably one of the biggest one out there. Join Hoke. We bring a lot of deals. We do a lot of the work for you. You can learn, but you can also build that muscle as a passive angel investor. If you're an active angel investor and you can get into that deal without a syndicate, be that helping hand for the founder. Like I am, as a founder, I'm very lucky. I have some really great angel investors that I know that I can call this person at 3 a.m. in the morning and they'll pick up my call. If you can be that person to founders, they will be so grateful to you and they'll reward you greatly. And also, like one thing you'll see is you will learn so much by being a support to founders. And if you can be an active angel and you have the money and the time to do it, it's actually very much worth it. I've seen some angels become founders or joining companies that they invested in. And I think that's a testament of how much they're willing to support these founders. So like angel investors, I think we need a lot more on the continent. It really, really matters that you can invest, but also get the money back. But like, just get started. Don't worry about that first 1,000. I know 1,000 is a lot of money, but it's the art of becoming an angel. You have to do the investment. Get that one out of the way. After a couple, if angel investment is not for you, there's so many other asset classes. I don't know if Fiend is taking money, but like I just think what Fiend is doing is so sexy because like I believe creative, cultural Africa is the future. And that area needs capital. And it's not your typical tech deal, right? And you find the right investment, you invest in a movie, you invest in a music, like it's just there's so much potential that I think more and more people, I don't know how your fundraising is going or if you've raised your fund, but I think like we need to funnel a lot of capital into what Fiend is doing because it really, really matters. One thing that Africans do really well is creativity and culture. Like look around the world. Like we own that space. And I think funds like Regal Capital should be getting a lot of funding. So
Thank you, Joe. Like I should have thank you.
I was just, all
Yeah,
right.
thank
So
you.
Finally, right? Guys, please start asking your questions. Drop them in the Q&A session. So stepping back, what does this exit say about the maturity and opportunities in Africa's venture ecosystem right now? We're seeing fintech dominate at nearly 40% of all acquisitions, but AI, healthcare, e-commerce are starting to emerge. Are we entering a new phase where exits are becoming more predictable and common, or is this still the exception that proves the rule? Joe?
If I look across our portfolio today, there is a very small percentage of companies I think will return capital. And that's just a harsh reality. I do think that we're seeing less, we're seeing less exit than other markets. There has to be more. And I think it's a function of the lack of liquidity in the markets, and everybody thinks that they're building the best thing and we're not collaborating. And you see, like I've seen some very wonky, weird exits where when a company knows that they're about to die, then they go and try to sell, and then they sell at a pretty shit price and everybody loses. I think we need to have more M&As sooner. I think founders need to get more comfortable with seven-figure exits, even six-figure exits. Really, like six figures, you raised 100K, somebody wants to buy your company at 500,000, pay the 100K back. That's 400K for you and your co-founders. That's 200K each if there's two of you. 200K is, in a lot of places in the world, is a lot of money. It gives you fuel to go build again. And the thing is, founders, great founders, they will keep building. We need to see more exits. Everybody wants to sell the company for 200 million. Paystack is the unicorn of the unicorns. Like it's a true outlier. Everybody wants to invest in MoneyPoint. MoneyPoint is a true outlier. And I think we need to really see early six, seven figure, eight figures would be great. But like $1 million is 140 million naira. Is that no 1.4 billion naira these days? That's an insane amount of money. But when you see people throwing numbers on Twitter, say, "Oh, a million I won't take," it's lies. It's like, please, we need to manufacture more exits. I think that will really get the ecosystem forward. Many founders, they probably can't build again because they sold the company for $1, and now they have to go get a job. And because you're in your 30s, you have to not take care of your family and your kids, and you probably don't have that same level of energy anymore. And that's just the truth of life. But I think, Shagun, that's why I love what you're doing. I think we need to see more exits, small, big, they really, really matter.
Can I chime in?
Hey.
Yes. Can I just speak
Oh,
quickly on?
yes, please go ahead.
Also, I think that because of this exit conversation is why we're starting to see yes, innovative sort of funding models, right? And that's why I think that again, the creative culture value unlock is there. And so when you find opportunities for founders to still own their businesses, and then you as an investor, you are able to exit when you want to at decent returns. Again, because some sectors won't just give you the 100x you're looking for, right? And the creative, realistically, sometimes in the creative or cultural space, you wouldn't find that. You wouldn't find that, right? But you'll find decent returns enough to, again, well again, and then do amazing things. Again, for the creative space, right? Where you start to think of, can we do revenue share? Is there some redeemable equity kind of model we can work with, right? So just different models that ensure that exit is sustainable. I think that's the conversation that I'm keen on. Exit is sustainable and is a bit more consistent. Whether it's 3x, whether it's 5x, whether it's 15x, people get their money back. And then that homegrown capital that we're always speaking about, saying we want more local investors, we want more African angels. We start to see a lot more traction on that level. So yes, I thought to just add this because again, as much as there's the VC, there's the tech, the power law want to be a unicorn, whatnot, right? There are other opportunities to also support high growth SMEs that will deliver to you returns in a shorter time frame.
Amazing, 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 amazing. Since we don't have questions and we're coming up in time, let me try to capture what we've learned today. I think the biggest takeaway for me is this: exits don't happen by accident, right? They're a result of smart sourcing, disciplined support, strong relationships, and knowing when to act. And Joe and Fee have shown us today, success in this ecosystem requires both patience. Before we wrap, I want to give each of you the last word. One closing thought or piece of advice for everyone here. Fee?
I won't say anything different. I would just say exits they're not events. It's very calculated. Is very much calculated, it's very much in alignment with the founder, is very much hinged on clarity. And the last thing is, again, that messing me do the discipline around it. We want to be intentional around it. So it'll be good to see that a lot more early stage investors are thinking around that line, and are able to deliver more returns to investors.
Joe?
I feel like I'm probably just going to repeat what Finn said. But I think that's we need to see more exits in the ecosystem, and we need to start thinking beyond tech startups because there's so many opportunities across the continent that will yield you good returns in dollars, and tech is not the only way. And I'm speaking as a tech founder, right? I think we need more angel investors across multiple asset classes, not just tech startups.
Thank you both for your candor and generosity in sharing this story. And thank you to everyone who joined us today. If you're interested in learning more about exit opportunities or selling equity for liquidity, you can reach out to us at Masai. We're here to help founders and investors navigate this critical moment. Have a great rest of your day, and we'll see you at the next session. June?
Thank you, Shigun. Thank you, Finn, and thank you, Joe, for such an insightful conversation. Yeah, it was a great way to end the virtual session for 2025 for ACES, and I hope to be seeing everyone who is here. We've kept the audience pretty much until this time, so I hope to see you in Cape Town. And thank you very much. Enjoy the rest of your day. Until next time, bye.
Bye. Thank you.